Hi there, Etoro. It is Monday the 20th of June, and that means it's time to take a look at what moved the markets last week. The eye-catching headlines continue, and last week was an awful week for the stock market. Who would have thought, given the number of awful weeks we've had now, but it was the worst week for the S&P 500 since 2020. The Dow Jones, tech stocks, the NASDAQ, the Russell 2000 all had an awful week. The one-week numbers here aren't exactly right for some reason, by the way. The S&P 500 was down more than 1 or 2%, 5.8% for the week. And so the carnage continues. When will we find a bottom? I read an interesting post by a fellow Etoro PI last week, and I like the way that he put it. The bottom of the market isn't a point in time or a place, it's more a process that happens. And right now the conditions aren't exactly good for stocks in the Western world. Inflation continues to be high, interest rates continue to rise, and some of them quite abruptly. And we need those two narratives to calm down before the stock market starts considering the valuation of individual companies, and buying companies on their merits instead of selling everything off wholesale. So what we can see on screen here is the NASDAQ 100. This is the weekly chart. A new recent low was set through last week. We see something similar for the S&P 500. That's on the right-hand side here. And at current levels, we aren't that far away from the 2019 highs before it all came crashing down. Some other interesting things to look at. So you know that I talk about Chinese stocks from time to time. So the CSI 300 remains in its upward channel from the enormous decline that it saw, the multi-year decline that it saw previously. And so this market has remained fairly resilient while most other markets in the Western world dropped significantly last week. I'll talk more about this in a moment. We also saw the yield curve, the spreads between the 10-year Treasury yields and the 2-year Treasury yields drop and get dangerously close to inverting. As I've mentioned previously, when the yield curve inverts, it's taken as a signal that a recession is coming. Now, I think that has more or less become a foregone conclusion at this point, so we don't really need yield curves to tell us that. Now, something that was interesting in terms of the selling last week is that energy stocks had dropped significantly. Now, energy stocks have been the darling of the stock market this year, some of them rising enormously from the beginning of the year. If you'd watched my previous videos, you will have seen that one of the large drivers of inflation at the moment, of course, is energy. And so investors are telling us something here. They're starting to signal that potentially there's going to be some weakness in the near-term future for energy stocks. And that might come about because if the Fed increases rates and other central banks increase rates, activity within an economy begins to slow, particularly if inflation is very high, so people are buying less things, companies need to tighten their belts, maybe there are layoffs. With people participating in the economy less, this means that demand for things like energy will start to drop too. We are also going into summer in the Northern Hemisphere, when certain types of energy such as natural gas are needed less. Now, if we look at previous rises and subsequent collapses in stock prices through the past 2 or 3 decades, you'll notice that there's more or less a pattern. A lot of these are preceded by a huge spike in energy prices. A large part of the stock market collapses, and then at some point during that collapse, energy stocks also begin to roll over. So this is potentially a sign of the advancing repricing that we're seeing in the stock market at the moment. So this chart makes it nice and obvious. These lines are quite thin, so I'm not sure if you can see them. These are the various sector-based ETFs within the US, and we can see that over the past year, XLE has been on a clanger and was up nearly 72% on the year. Over the past week, so that's from June 8th through to June 17th, that has dropped from being up 73% on the year to 37% on the year. Still a decent return given that all of the other sector-based ETFs are down here, most of them below water. But this is showing you the degree to which energy stocks are starting to roll over. This could be a pretty good sign too, and that a large component of recent inflation reads has been energy prices. So if energy prices are going to drop off sharply, that's pretty good news from an inflation perspective. Now, while we're here, something else that is quite interesting is that if we shift this out to the longer term view for those longer term investors out there, this top line, this probably aquamarine line, has seen a pretty large collapse over the past half a year or so. The collapse has been larger than any of the other sector-based ETFs. But despite that, over this 3-year period, the tech sector is still pretty significantly higher than the second best performing sector-based ETF. I'm pretty sure this is going to be a trend that continues through the next 5, 10, 20 years. And so this is where I have and will continue to put my money. Now, part of what caused the craziness last week was that the week before that, we saw that high read of inflation out of the US. There was then an anticipation that the US Fed would raise interest rates by higher than the 50 basis points hike that everyone had previously expected. And in fact, that's exactly what happened on Wednesday of last week. We also saw the UK Bank of England, the central bank, raise interest rates once again. And then there was a little bit of a surprise with the Swiss National Bank raising its interest rate moves. That was a big surprise that caught a lot of people off guard. So once again, like I've said, the market right now doesn't really care about valuations of individual stocks. Everything has become highly correlated in a move downwards. This is driven by fear. And I don't expect a meaningful turn in sentiment. I think that we might get some relief rallies, but I don't think we'll see a meaningful turn in sentiment until those narratives start to break down, until we have data that inflation is definitely moving lower, which will then set the market's expectation that central banks will, take the foot off the brake a little bit at least. Now, I do expect that we will see something of a relief rally in the near-term future. One of the reasons for this, there are many indicators, but one that is just extreme is the fact that the number of S&P 500 stocks trading above their 50-day average right now is sitting at 1.98%. Now, if we zoom out, we'll see that a lot of these lows coincide with very scary, very big drops in the stock market. And a lot of these scary moments had the same reading, the number of S&P 500 stocks above their 50-day moving average, at higher points than what we have at the moment. To me, this signals that the market is incredibly oversold. If we look at the number of stocks trading above their 200-day moving average from the S&P 500, that's sitting at 11.48%. Now, historically speaking, in other moments of great fear in the stock market, that has gone lower. For example, we see here that in March 2020, the coronavirus collapse, that we just had 3% of stocks above their 200-day moving average. This does seem to signal, at least on a short-term basis, that the stock market is quite oversold. Now, I mentioned that the market is not going to be looking at valuations whilst the current narrative, the joint narrative of inflation and interest rates are dominating the mind space. So we should keep a close eye on those measures. Now, this is the one that came out 2 weeks ago that caused a lot of hullabaloo and forced the Fed's hand at raising 75 basis points last week. And we can see that inflation, at least at a headline level, increased slightly from 2 months ago. And I spoke in my last video about the breakdown of this particular reading. I also mentioned that if you look at the composition of inflation from a few different perspectives, it becomes pretty evident that part of the inflation pie is beginning to roll over. I also suspect that the price action that we're seeing in energy stocks is reflecting that energy prices are going to come down, and I think that we have either reached a top or the top is in the rearview mirror when it comes to the inflation rate. Remember, inflation is a lagging indicator. It's a measurement of something that's already happened. So basing future actions on past data isn't always a very good plan. Something a little different that I wanted to talk about this week, something that I've been monitoring for the past few years, are quadrants that are used a lot by hedge funds and in particular macro traders. This is a really good newsletter, by the way. The style of trading reflected in this newsletter doesn't match mine whatsoever, but I'm always interested in what I can learn from other styles of trading and investment. Now, this particular newsletter is about how you can use these various quadrants to determine where you are within a particular cycle and also what types of assets you might want to trade. And there are a number of different takes on this. I think Ray Dalio's company was one of the first that made these quadrants really popular, but I wanted to look at this one in particular because it is simple to understand. The way you read this quadrant chart is that you've got prices of things increasing towards the top and decreasing towards the bottom, and you have economic activity, GDP growth, increasing towards the right and decreasing towards the left. And so broadly speaking, there are 4 different situations that you might find yourself in. Inflationary boom, where prices are rising as well as economic activity is fantastic. Inflationary bust, where economic activity is slowing or negative, but prices are still rising. Disinflationary bust, where economic activity, GDP, is going down and prices are going down. And disinflationary boom, where prices are going down and economic activity is going up. Now, in terms of very recent history, we probably found ourselves in the bottom right-hand corner through second half of 2020. We subsequently found ourselves in the inflationary boom phase through much of 2021, so inflation rising, but also GDP and earnings growing. We now find ourselves firmly in the inflationary bust kind of area. Inflation is high, but GDP is slowing incredibly. And I think we will be moving into the bottom left-hand quadrant fairly shortly in the next few months or quarters. The way that macro traders make money from this is that they try to pinpoint when the regime will shift from one quadrant to the other. It all seems nice and simple when you read it on a screen, but actually pinpointing the exact point in time where you move from one to the next is incredibly difficult, and getting that timing wrong can cost you a lot of money. So if you were a trader and you knew that we will shortly be moving into this kind of phase, then you would buy bonds and sell just about everything else. However, I don't think we will spend very long in this bottom left-hand area, a few months to a few quarters, and then central banks will again begin trying to stoke the fires of economic growth, because the world is in a very delicate place at the moment, and they will want to start pushing us towards the right-hand side of this chart as soon as they have the ability to, i.e. once inflation begins to come down in a meaningful way. Now, the example that I've spoken about reflects mostly the Western world in terms of where we've been in the journey through these quadrants. What I find particularly interesting right now is that China is on its own journey through these quadrants in terms of timing. So as I mentioned before, the CSI 300, the Chinese S&P 500, is still in an uptrend. The Chinese government and central banks have been trying to stoke the fires of growth for a while, and there hasn't been a lot of action, but it seems as though we are seeing something now. Their policy with regards to coronavirus is proving a bit of a challenge, but they have reopened parts of their economy, and I think it's going to be a messy journey back towards full-blown growth, but it looks as though it has started. One fairly reliable indicator that we can use to measure this is the Chinese credit impulse. This is typically a leading indicator of economic growth. That makes sense, right? When the value of loans to your overall GDP increases, when more credit is injected into the system, that means that people have more money to spend, more money to invest in their businesses, and we begin to see growth. We are missing a few data points in this chart, but you can see that the Chinese credit impulse had begun ticking up, and it seems as though the CSI 300 are now beginning to follow that. So what does that mean in terms of the quadrants in this particular setup? Well, I think that China has been in the bottom left-hand corner for a fairly long time now. I'm going to ignore the buy recommendation there, because rising yields in the US means that people are now rushing to buy US bonds and exiting Chinese bonds. But I would still say that China spent the bulk of this year, maybe part of last year, in this bottom left-hand quadrant, and is now slowly making its way over to probably the bottom right of this chart. I don't think they're at the top right just yet. I do like what I'm seeing in terms of price action for the CSI 300. We can see that sentiment is strong enough that the index has breached. It's taken the 100-day moving average, but I would like to see it break through the 200-day moving average before I add to my current Chinese investment. All right, in terms of economic data, we're going to get a smattering of different pieces of data through this week. Home sales will be an interesting one in the US. I'm not sure if you've been following the news, but home sales are massively down in the US because the mortgage rates have risen so much. Demand is dropping, so prices are dropping. I'll be particularly interested, and the market will be particularly interested in the CPI reading out of the UK, as well as the PMI data. And I'm always interested to hear what Fed Chair Powell has to say. All right, that's it for this week. I hope you have a fantastic one, and I'll speak to you next week. Goodbye.